Right now, at this exact moment, there are millions of retired Americans receiving a Social Security check every month that is smaller than it should be. Not by a little, in many cases by hundreds of dollars. And the part that makes this genuinely painful is that it is not happening because of some unfair government rule they cannot fight. It is not happening because of bad luck or bad timing. It is happening because of specific, correctable mistakes, things that are completely fixable once you know they exist. And most of the people this is happening to have absolutely no idea. They deposit their check, they budget around it, and they assume the number is correct, but it is not. And today I am going to show you exactly why. My name is Finn, and this is Finn Retires, the channel that exists to make sure your retirement income is as protected, as accurate, and as large as it is legally supposed to be. If you are new here, please hit that subscribe button right now before we go any further. Every week on this channel, we cover the rules, the mistakes, and the overlooked details that most retirees never hear about until it costs them money. Today, we are talking about 5 specific Social Security mistakes that are quietly shrinking monthly checks in 2026. And I want you to watch this video with a notepad nearby, because every single one of these comes with an action step you can take this week. So, subscribe, stay with me, and let us get into it. Let me start with a number that I think sets the stage for everything we are going to talk about today. As of mid-2026, the Social Security Administration has paid out $17 billion in retroactive payments to over 3 million beneficiaries following a historic change in Social Security law. $17 billion, spread across 3 million people. And yet, a significant number of retirees who are legally entitled to a portion of that money, people who qualify right now, have not received it. Not because the government decided not to pay them, but because they do not know they qualify. They have not checked their account, and in some cases, they have not even filed the right paperwork. That is not a political statement. That is a data point. And it is the perfect example of how money that belongs to retirees quietly stays out of their pockets simply because of a gap in information. That is what today's video is about. Not abstract concepts, not things that might happen someday. 5 specific mistakes that are happening right now to real people and that are costing real money every single month. Let us talk about the first mistake, and this one has a very specific context in 2026 that makes it more urgent than it has ever been before. On January 5, 2025, President Biden signed the Social Security Fairness Act into law. This legislation did something that Social Security reform advocates had been pushing for over 40 years. It repealed 2 provisions known as the windfall elimination provision and the government pension offset. Before this law was passed, these 2 provisions had been quietly reducing, or in some cases completely eliminating, Social Security benefits for millions of Americans who had worked in public sector jobs. Teachers, police officers, firefighters, federal employees covered under certain pension systems, and state and local government workers whose jobs did not pay into Social Security. The windfall elimination provision reduced your own Social Security retirement benefit if you also received a pension from one of those non-covered jobs. The government pension offset went even further. It reduced spousal and survivor benefits by 2/3 of the amount of your public pension, which in many cases wiped out the spousal or survivor benefit entirely. A retired California school teacher whose husband paid into Social Security his entire career could watch her survivor benefit drop to 0 on the day she filed, simply because of her teacher's pension. That was the law for decades. And then, in January of 2025, it changed. The Social Security Fairness Act made this change retroactive to January of 2024, meaning December 2023 was the last month that either of these provisions applied. The SSA began processing retroactive payments in early 2025 and has since sent over $17 billion to more than 3 million affected beneficiaries. For a retired teacher whose WEP cut was $500 a month, that is $6,000 a year, plus 2 years of back pay, plus a permanent monthly increase going forward. The numbers are significant and real. But here is the first mistake, and it is a critical one. A meaningful number of retirees who are eligible for this benefit increase and this back pay have still not received it or confirmed it because they have not checked. Some of them were told years ago by SSA representatives that they would not qualify for spousal or survivor benefits because of GPO, and they stopped pursuing it. The Fairness Act changed that, but SSA cannot always identify and contact every affected person automatically, particularly those who never filed because they assumed their benefit would be zero. If you spent any portion of your career in a job that did not pay into Social Security, a classroom, a police department, a government office, log into your My Social Security account at ssa.gov right now and compare your current benefit to what you were receiving before early 2025. If the number has not changed, or if you never filed because you were told it was not worth it, call the Social Security Administration directly at 1-800-772-1213. This may be the most valuable phone call you make this year. The second mistake is one that catches retirees off guard more than almost anything else, and it specifically affects people who are collecting Social Security benefits before their full retirement age while also continuing to work in some capacity, even part-time. This is the earnings test, and if you do not know this rule exists, it can feel like money is simply disappearing from your check without explanation. Here's how it works. If you are receiving Social Security retirement benefits before you have reached your full retirement age, which for most people today is 67, and you earn income above a certain annual threshold, the Social Security Administration will withhold a portion of your benefits. In 2026, that threshold is $24,480 per year. For every $2 you earn above that amount, the SSA withholds $1 from your Social Security benefit. So if you are receiving a monthly Social Security payment and you take on a part-time consulting job that pays $30,000 a year, you have earned $5,520 above the threshold, which means the SSA will withhold $2,760 from your benefits for the year. Spread across 12 months, that is $230 per month that quietly disappears from your check. Now, there is an important clarification here that many people do not know. The amounts withheld because of the earnings test are not permanently lost. Once you reach your full retirement age, the Social Security Administration recalculates your benefit to give you credit for the months during which your payments were withheld. Your monthly benefit going forward is permanently adjusted upward to account for it. So the earnings test is not a permanent penalty in the way that early claiming is. But in the short term, it absolutely reduces the check you receive each month. And for retirees who are budgeting around a specific income number, that reduction can cause real financial stress. There is also a separate, more generous threshold that applies in the specific calendar year you reach your full retirement age. In 2026, that threshold is $65,160, and in that year, only $1 is withheld for every $3 above the limit, not every $2. And once you actually reach your full retirement age, the earnings test disappears completely. You can earn any amount from work and receive your full monthly benefit with no reduction. The action step here is simple. If you are collecting Social Security and you are still earning income, know where you stand relative to these thresholds. Do not let the withholding surprise you at a moment when you need your full check. The third mistake is one that I think gets less attention than it deserves, and it has been quietly affecting retirees for years. This is the mistake of never verifying the accuracy of your Social Security earnings record. Your Social Security benefit is calculated using your highest 35 years of earnings, specifically the wages on which you paid Social Security taxes over the course of your working life. The Social Security Administration maintains a record of those earnings going back to the very beginning of your career, and that record is not perfect. Errors happen. Employers report wage information incorrectly. Wages get attributed to the wrong Social Security number. A year of earnings gets missing entirely from the record. And because most retirees never check their earnings history before filing, they never catch these errors, which means their benefit is calculated on an incomplete or inaccurate foundation for the rest of their retirement. Even one missing year of earnings in your record can lower your monthly benefit permanently. because the SSA replaces missing earning years with zeros in the calculation. If you have a year that should show $40,000 in earnings but shows zero because of a reporting error, your average indexed monthly earnings, the number used to calculate your benefit, is lower than it should be, and your monthly check reflects that permanently. The fix for this is straightforward and it costs nothing. Log into your My Social Security account at ssa.gov and pull your Social Security statement. It shows your earnings record going back to the very first year you worked. Go through it carefully. Check that the wages reported each year match what you actually earned. If you find a year where the number looks wrong, too low, missing, or zero when you know you worked that year, gather your documentation. W-2 forms, old tax returns, pay stubs if you have them. Contact the Social Security Administration and request a correction. This process takes time and requires paperwork, but it can result in a permanent increase to your monthly benefit. If you are not yet receiving benefits and you are a few years away from filing, doing this check now gives you the maximum amount of time to correct any errors before they are locked into your benefit calculation. If you are already receiving benefits and you discover an error in years that were included in your calculation, you can still request a correction. Though the process is more complex at that stage, it is not impossible. The fourth mistake is one that affects married retirees in particular, and it is a mistake that costs couples significant money simply because they never fully explored the spousal benefit rules. Under Social Security law, a spouse is entitled to receive a benefit based on their own earnings record, or up to 50% of their spouse's primary insurance amount, whichever is higher. The primary insurance amount is the full benefit the higher-earning spouse would receive at their exact full retirement age. For many couples, this spousal benefit option represents a significantly larger monthly payment than the lower-earning spouse's own earned benefit would provide. And yet, a surprising number of married retirees are collecting only their own earned benefit, leaving the spousal benefit completely unclaimed, either because they did not know they qualified or because they did not realize the spousal calculation could result in a higher number. Let me give you a concrete example. If one spouse has a primary insurance amount of $2,400 a month, the other spouse may be entitled to up to $1,200 per month as a spousal benefit, regardless of what their own earnings record looks like. If their own earned benefit is only $800 a month, the spousal benefit of $1,200 is $400 more every single month. Over a year, that is $4,800. Over 10 years, that is $48,000. That is not a rounding error. That is a meaningful component of retirement income that some couples never access simply because they did not know to ask. There are several rules attached to the spousal benefit that are worth understanding. The working spouse must have already filed for their own retirement benefit before the other spouse can receive a spousal benefit. The spousal benefit is reduced if claimed before the spouse's own full retirement age. The same reduction percentages apply. And the spousal benefit is always based on the higher earner's primary insurance amount, not on the actual amount the higher earner is receiving, which matters if the higher earner claimed early and is receiving a reduced benefit. If you are married and you are not certain whether your spouse is receiving the correct benefit, this is worth a direct conversation with the Social Security Administration or a qualified Social Security advisor. The fifth mistake is one that quietly affects retirement budgets at the end of every year, and it is a mistake that is entirely preventable with a single piece of paperwork. This is the mistake of not setting up proper federal tax withholding from Social Security payments. Many retirees do not realize that a portion of their Social Security benefit may be subject to federal income tax. Depending on your combined income, which the IRS defines as your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefit, up to 85% of your Social Security income can be taxable. For retirees who also receive pension income, IRA distributions, or investment income, combined income above the relevant thresholds makes a portion of Social Security taxable in most cases. Here is where the mistake happens. If you do not set up voluntary federal tax withholding from your Social Security payments, the full gross amount of your monthly benefit is deposited into your account each month, and nothing is withheld for federal taxes. This feels like a full check every month, but at tax time in April, the bill arrives. And for some retirees, particularly those who do not make estimated quarterly tax payments either, that bill can be significant. The Social Security Administration offers a completely free and simple solution called a voluntary withholding request, which you submit using Form W-4V. On this form, you choose to have either 7%, 10%, 12%, or 22% of your monthly Social Security benefit withheld for federal income taxes, automatically, before your check is deposited. The right percentage depends on your overall tax situation, and a tax professional can help you choose the appropriate rate. But the effect of setting this up correctly is that you eliminate the year-end tax surprise, your quarterly cash flow is more predictable, and you are never caught in a position where you owe money you have already spent. This one form, properly completed and submitted to the SSA, can prevent thousands of dollars in unexpected tax liability from disrupting your retirement budget year after year. Now, I want to take a moment and address something that goes beyond just the 5 mistakes we covered today. If you have been receiving Social Security for several years and you are not sure whether any of these apply to you, please do not assume that they do not. The Social Security system is complex, the rules change, and the SSA, while doing its best with an enormous caseload, cannot always proactively reach every person who may be affected by a rule change or who may have an error in their record. The responsibility for catching these things falls largely on the retiree, and that is not fair, but it is the reality. What you can do about it is spend 20 minutes this week logging into your My Social Security account, reviewing your earnings record, checking whether your current benefit reflects the Fairness Act changes if they apply to you, and confirming whether your withholding setup matches your actual tax situation. Those 20 minutes could result in a permanent monthly increase to your check, a lump sum back payment, or a tax situation that no longer catches you off guard in April. That is a very good return on 20 minutes. Let me also quickly mention something that every retiree watching should be aware of for longer-term planning. The 2025 Social Security Trustees Report moved the projected insolvency date for the combined Social Security trust funds forward to 2034. If Congress does not act before that date, an automatic benefit reduction of approximately 19% would be triggered across the board. On an average monthly benefit of around $2,000, a 19% cut is roughly $380 per month. That is 8 years away, not 30. I am not saying this to alarm you, and there is genuine reason to believe Congress will act before 2034 in some form. But it is worth knowing the timeline so you can plan with clear eyes rather than assumptions. Here is what I want you to do right now. First, go to ssa.gov, log into your My Social Security account, and pull your earnings record and your benefit statement. Check the numbers. Second, if you ever worked in a public sector job with a pension, call SSA and confirm that the Fairness Act changes have been properly applied to your account. Third, if you are claiming before your full retirement age and still earning income, know your earnings test threshold and track where you are relative to it. Fourth, if you are married, confirm that you and your spouse are both receiving the correct benefit type for your situation. Fifth, submit Form W-4V to the SSA to set up voluntary federal tax withholding if you have not already done so. If this video helped you understand something about your own Social Security situation that you did not know before, I am going to ask you to do one thing: share this with someone in your life who is retired or getting close to retirement. The 5 mistakes in this video are not rare edge cases. They are affecting millions of Americans right now, in 2026. One share from you today could put real money back into someone else's monthly check, and that matters. Drop a comment below and tell me, which one of these 5 mistakes surprised you the most? Was it the Social Security Fairness Act and the retroactive payments, the earnings test, the earnings record errors, the spousal benefit rules, or the withholding setup? Tell me which one caught your attention. I read every comment on this channel, and your response helps me understand what to cover next for this community. The next video on this channel is going even deeper into Social Security. specifically what the taxability rules mean for your monthly income and the legal strategies retirees can use to reduce how much of their benefit goes back to the IRS every year. If you are not yet subscribed, hit that button now. You do not want to miss it. Take care of yourself, protect your retirement, and I will see you in the next one.